Hi, I'm Ed Fulbright, CPA, CGMA, PFS, a Fulbright Financial Consulting PA. We would like to welcome you to our educational briefing.
Congress moved closer to enacting the most sweeping tax reform legislation in over 30 years last week, driving stocks to new record highs again. We don't know all of the tax law's final details, and they won't be settled in Congress until late December, but we do know that the new tax code is going to eliminate many deductions, which gives you one last chance ever to make some deductible expenses by December 31st to deduct them on your 2017 tax bill. Here's this week's news about your money. Federal deductions for state and local income taxes, as well as property taxes, are likely to be limited or entirely eliminated in 2018. And property tax deductions are likely to be capped. Residents of high tax places with high real estate prices and high incomes are going to be hit hardest financially by the loss of state and local income tax deductions on federal income tax returns. California, Connecticut, Massachusetts, New Jersey, and New York have condemned this tax provision, saying it will raise the tax burden of millions of households, depress real estate prices in those places, and diminish the retirement nest egg of millions of suburban households, which happen to be concentrated in blue states, traditionally controlled by Democrats. The differences between the House and Senate proposals are not insurmountable, and other deductions will be eliminated entirely. Taking advantage of these deductions while they're still around in 2017 requires some planning and action by the end of the year while the exact wording of the new U.S. tax code is being worked out in Congress. It's always good to give to charity, but the tax law is adding a new urgency to charitable giving. The House and Senate versions of the tax law would both simplify tax filing in 2018 by eliminating deductions for charitable contributions unless you itemize deductions on your tax return. That change in the law worries charities because fewer individuals will have a tax incentive to give. Big donors are likely to retain deductions and continue to give, however. The change in the tax treatment of charitable contributions may also affect your decisions about giving between now and the end of the year. If you've been itemizing deductions every year, and the final tax law eliminates your itemized deductions in 2018 for state, local, and property taxes and mortgage interest, while the standard deduction doubles to $24,000, then you may want to boost donations through the end of 2017 before you are disqualified from taking the deduction. If you have wealth concentrated in a single stock, the Senate version of the tax bill would end a tactic, allowing you to choose which lot of securities to sell. Under current law, you can choose to sell securities using three methods of accounting: first in, first out, or FIFO, last in, first out, or LIFO, or you can choose specific lots you want to sell. The Senate version of the law is important to you if a large part of your wealth is in a single company and you've been purchasing shares over a decade or longer. Typically, you're going to want to consider how to maximize the sale of lots purchased in recent years that might have losses to offset older lots of shares with the largest taxable gains. If the Senate version becomes law, you would no longer be allowed to choose which lots of securities to sell to minimize capital gain taxes. Not many people are affected by this change, but if you know anyone in this situation, you may want to share this video with them because they may be able to save real money by acting by the end of December. Though the new tax law won't be finalized until late December, it would be unwise to wait for the bill to be final to take action. Too much tax savings could be at stake to risk running out of time to act. If you are affected by any of these tax situations, please call us to discuss your circumstances. And if you know someone who is likely to be affected by these rules, feel free to pass along this video. With so little time before the year ends to act, please check for tax alerts delivered in our email newsletter. The tax cuts make it more certain that earnings for 2018 and 2019 are going to get bumped up. Generally, Wall Street forecasters expect earnings in 2018 and 2019 to get an 8% bump because of the new tax law. What's that worth? No one knows for sure, but barring some major disruption to the historical norm, the price of the S&P 500 would stay in this band shown here in these red dotted lines. If you apply a market multiple of 19 to current earnings estimates of the companies in the S&P 500 index, the upper line of the band shows the S&P 500 price would rise to 30.53. The lower band shows the earnings expected at the end of 2019 would put the S&P 500 at 27.31, assuming a more conservative multiple of 17. With earnings expected to rise by 8%, the upper band rises to 32.97 at the end of 2019, and the lower band rises to 29.50. For sure, the corporate tax cut is good news for U.S. stocks. The S&P 500 currently trades at 20.5 times its trailing 12-month earnings, which looks expensive by historical standards. But if you look just ahead at the coming earnings surge spurred by the new tax laws, the S&P 500 is trading at just 16.7 times its 2018 earnings, which is low by historical standards. Stocks, which for months have repeatedly broken record highs, did it again on Friday, closing at 2651.50, despite some lingering uncertainty about tax reform and a major U.S. political scandal. The S&P 500 stock index has been fulfilling its role as the key growth component in diversified portfolios, and it's not priced irrationally. Still, a 10 or 15% drop could occur at any time on bad news, and the chance of a bear market decline of 20% or more increases as the 8.5-year bull market grows older. However, new job numbers last week were outstanding. All major signals show economic strength is building, and the new tax law is one more piece of good news. This bull market could continue, possibly for a long time, and head higher still.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.